There's a high-stake battle brewing over the future of your money. It's a quiet war fought on not some bloody battlefield, but in the halls of Congress and across global financial systems server. On one side, you have the banking giants that have held your cash for generations. On the other, the new world of cryptocurrency, promising something your bank simply can't and maybe won't offer: a real return on your savings. What if you could actually earn a decent yield on your cash instead of the fraction of a percent your bank might be offering? It sounds pretty good, right? But banks are warning it could become a total nightmare for the financial system. At the heart of this conflict is the new legislation, and bankers are sounding the alarm that the latest proposal leaves your deposit and the loans they fund dangerously exposed. The core of the issue boils down to a simple concept: deposit flight. For decades, banks have relied on your checking and saving deposit as a cheap and stable source of funding. They take that money and lend it out for mortgages, small business loans, and car loans. Basically, the power or their economy. Now that the entire model is being challenged by yield-bearing stablecoins, these are digital dollars backed one-to-one with US dollars, but with the potential to offer rewards that make traditional saving accounts look pathetic. How to do that? It's because they are backed with government bonds, and their yield are given to the holders of stablecoins, or at least that is the plan. Legislation is desperately trying to catch up. A bill known as the Clarity Act is being debated, attempting to create a regulatory framework for these powerful new assets. But America's largest bank group, like the American Bankers Association, have come up swinging. In a recent joint statement, they argued that a new compromise in the bill, designed to limit how stablecoins can pay out the rewards, is riddled with loopholes. They are warning that as drafted, the bill fails to protect the traditional banking system from what could be a massive exodus of funds. And they're not just worried about their bottom line, they're pointing to a potential systemic risk. The American Bankers Association has made stopping stablecoin yields a top priority for 2026. Some banking executives have warned that widespread adoption could drain trillions of dollars from the US banking system. This, they argue, could slash the amount of money available for the very consumer and small business loans that keep the economy moving. Bankers argue this whole situation creates a fundamentally uneven playing field. They operate under a mountain of regulation with strict capital requirements and oversight designed to protect you and the economy. Your deposits are federally insured. Stablecoin issuers, they claim, could operate under a much lighter set of rules, offering higher returns precisely because they don't have the same costs and safeguards. The fear is that you, understandably drawn to higher yields, will move your cash from an insured bank account to a stablecoin wallet, but if that stablecoin issuer were to fail, your money isn't protected by the same federal safety net that backs your bank deposits. The latest legislative compromise tries to thread this needle. It includes a broad ban on payments that are economically or functionally equivalent to the interest you get from a bank. However, the Banking Association claimed this language is too vague and full of holes. They say crypto platforms could still offer rewards based on how long and how much you hold, which directly incentivizes parking your money in stablecoins, undermining the whole point of the ban. They see this as a backdoor way for crypto platforms to offer what are basically bank-like interest payments without any of the bank-like rules. Of course, the crypto industry sees this completely differently. For them, this isn't about undermining the financial system. It's about upgrading it. They argue that stablecoins offer a more efficient, innovative way to handle payments and that consumers deserve the right to earn a better return on their money. From their perspective, the banking industry is just trying to protect its long-held monopoly on deposits and shut down the competition. Proponents in the crypto space believe that this is a step towards a new monetary standard where crypto dollars give people more choice and cut out the middleman. They envision a more inclusive financial system where everything from paying suppliers to receiving your paycheck can happen instantly on-chain without waiting days for traditional banks to clear transactions. Major crypto players like Coinbase have signaled they can live with the compromise, suggesting it clears a path for much-needed regulatory clarity that could finally legitimize the industry and the stablecoin yield-bearing agenda. So where does this leave us? The Clarity Act is still being negotiated in the Senate Banking Committee. The clock is ticking, and with midterm election approaching, it's unclear if a final bill can pass before the political landscape shifts again. Some analysts warn that if certain crypto-skeptical figures like Elizabeth Warren or Sherrod Brown were to lead the committee in the future, legislation like this could face a much tougher road. The outcome will have a massive implication. Will Congress side with the banks, closing the loophole and protecting the traditional deposit base, or will they favor innovation, potentially unlocking a new era of digital finance but also introducing a whole new set of risks? This is one of the most important financial debates of our time, and the outcome could going to be directly affecting you, how to spend, how to save, and how to earn money for years to come. That's why it's important to stay informed. But what are your thoughts? Should stablecoin be allowed to offer yields that compete with banks? Or are the risks of deposit flight and financial instability just too great? Let me know what you think down in the comments, and if you want to stay updated on this battle between the banking titans and crypto challengers, make sure to subscribe for more contents like this. If you like this content, make sure you want to check out this next video about Bitcoin's quantum risk. Stay safe guys, stay curious, and I'll see you guys next time.